welcome to another video of Forex Institute. In this video, I'm going to be talking about Forex indicators. I'm going to be explaining what Forex indicators are, the different types of Forex indicators you can use, and I'll be explaining how you can use these Forex indicators to improve your technical analysis. The misconception about Forex indicators: a lot of beginner traders have this common misconception of Forex indicators, that Forex indicators are always right and you only need a Forex indicator to make a profitable trade. I'll be explaining why this ideology is not true and how we can use Forex indicators. Alright, let's get into the video. So, what are indicators? A Forex indicator is a mathematical calculation that allows you to analyze or examine market data. Indicators seek to predict how the market will behave in the future and which patterns are likely to be repeated by examining historical data such as currency price, the volume. Volume means the amount of traders in the market, and market performance. So Forex indicators get their prediction from the closing prices of past data and try to predict what may happen in the future. We come to different types of indicators. We have two categories of indicators. The first one are leading indicators or oscillators. These indicators are the ones that try to predict the future price trend before price actually makes the move. Then we have the lagging indicator or the trend following indicators, which usually reacts to price after price has made its move and follow the trend in which price is currently in. Leading indicators or oscillators. A leading indicator gives a signal before the new trend or reversal occurs. Leading indicators typically work by measuring how overbought or oversold the currency pair is. Overbought meaning price has been buying too much and now price may be getting ready for a reversal. And oversold means the price has sold too much and price may be coming for a reversal. This is done by the assumption that if a price is oversold, it will bounce back, and if price is overbought, it will begin to fall. You might be thinking, why don't we just trade using leading indicators since they predict what price will do next? Indicators are not always accurate, so a leading indicator may be indicating that price will reverse, but price may continue moving in that direction. This is why you need to have multiple confluences that will show you if a price is reversing or continuing. So you can just use indicators to add on to your confluences to see if the indicator is actually right. And if your confluences are in alignment with your indicator, you can then have more confidence in taking your trade. We would be using these indicators if they are right 100% of the time. But as I continually say, market conditions are always changing. These indicators should be used only for additional confirmation to enter a trade. When you solely depend on leading indicators, you will experience a good number of fake outs. Fake out simply means price is showing that it has broken a certain resistance or support level and it just retains from that zone. Actually, it really hasn't broken that zone. We come to lagging indicators or trend following indicators. A lagging indicator gives a signal after the trend has started. They do not warn us of any upcoming changes in prices. They simply tell you what prices are doing, either rising or falling, so that you can trade accordingly. The downside of lagging indicators is lagging indicators signal change in trend direction late after the new trend has been established. This will lead you to miss the beginning of the move and miss out on a good number of pips. So lagging indicators usually signal a change in trend direction after the trend has already changed or has already been established. And usually, if traders solely depend on these indicators, they may find out that they have missed out on a good number of pips, and they will have to put their stop loss further away from their entry level. We come to types of leading indicators. I'll be explaining the types of leading indicators and how you can use these leading indicators to improve your trading overall. So you have to choose which indicator best suits your strategy or the way you trade, and you can go on from there. Every trader has different types of indicators they use. All that matters is that indicator is working for you. You start with the relative strength index, or the RSI. I'm sure most of you have heard of this indicator, and some of you might have used it. The RSI is a momentum indicator or an oscillator that indicates whether a market has been overbought or oversold. The RSI is an oscillator, meaning it has a scale from 0 to 100. When the indicator reading is above 70, it means that the market has been overbought and there might be a reversal coming. If the RSI reading is below 30, it means the market is oversold and there might be a bullish reversal coming. So this is the RSI indicator. So whenever you put the RSI indicator on your chart, this indicator always comes below your chart so that you can see how price is moving. So if the RSI indicator comes above 70, start expecting a reversal to happen, though a reversal may not happen immediately. So it is important for you to look for additional confluence for you to have a strong conviction that that reversal has a potential of happening. Then if price comes below 30, it means price has been oversold and there may be a bullish reversal. So again, it's not always confirmed that if price comes below 30, price will immediately start to reverse. So you have to start looking for indications on price that are showing you that a reversal might begin to happen. So indicators usually follow what price is doing, and price does not follow what indicators are doing. Let me say that again. Price does not follow what indicators are doing. Indicators follow what price is doing. So do not put your focus on indicators. Put your focus on what price is actually doing. Just use the indicator as additional confluence for entering the trade. How to trade using the RSI. When you have a buy position open, meaning that you are predicting the price will gain strength or go up in layman's language, you might use the overbought signal to take some profits. So if your position is open and price has gone above 70, you might use this as a signal to start locking in some of the profits, and you can continue to look for additional confirmation to close the whole position. So it's important to lock some profits rather than leaving the market without any profit at all. So you can use the RSI to indicate whether it's time for you to take some partial profits. If you are looking to enter a sell position, you might use the overbought signal as additional confirmation to do so. If you are looking to enter a buy position, you can use the oversold signal as additional confirmation to enter the trade. If you have a sell position open, you can use the oversold signal to take your profits. So this is how you can use the oversold signal to improve on your trading. If this indicator is appealing to you, you might try to use it in your trading strategy and see how it works for you. We come to the stochastic oscillator. Similar to the RSI, the stochastic oscillator is used to identify the end and the beginning of a trend. It does not follow price or volume, but the speed and momentum of the market. Again, it does not follow price or volume, but the speed and the momentum of the market. It compares the most recent closing price relative to the previous trading range over a certain period of time. The stochastic indicator is an oscillator, meaning it has a scale of 0 to 100. If the reading is over 80, the market is considered to be overbought, while if the reading is under 20, it would be considered to be oversold. These are the same principles that apply to the relative strength index. So here we have an example. The green line here is the 80 level, and the red line here is the 20 level. This trader was on the 5-minute time frame. I do not advise you to trade lower time frames because lower time frames are noisy and they may distort your bias. So here price came above the 80 level and began to fall. Mind you, most of the time price does not accurately react like this. This was just used for example purposes. You can use this for additional confirmation. So if this was a key significant level and price retraced back to a key Fibonacci level, you can use this crossover here as additional confirmation for entering this specific trade. So price came here, found resistance. We also have a reversal here. We also have a crossover above the 80 level. So this may indicate a potential move. We have these bullish candles that indicate bullish strength, but then the bullish strength here started to decrease, and this was indicating bearish strength coming into the market. So all these are confluences for us to enter the trade. We execute the trade without holding on to the trade and use good risk management. Enter the trade, and price reacted very well. So price came below 20 here, began to retrace back up, and then price came above 80 and began to fall. Price came below 20, began to rise, and so on. How to trade using the stochastic oscillator. You can use it the same way you use the relative strength index. Fundamentals. Fundamentals or news. Fundamentals or news can be used as a leading indicator. When news is set to be announced or being announced, traders use this information to add on to their confirmation of a bias and to enter a trade. You can find the news on an economic calendar. This is a link to the specific economic calendar I use. I will post this document in our Telegram channel, so you can head over there and download the document from there. We also post exclusive content in our Telegram channel, so make sure to subscribe. Other leading indicators are the average trading range and the average directional index. I will make another document explaining what these other indicators are used for and what they actually do and how you can use them in your trading. So make sure to subscribe to our Telegram channel. I will post this document during the course of the coming week. Types of lagging indicators. We have the moving average indicator. Any indicator based on the moving average is considered to be a lagging indicator. One of the benefits of a lagging indicator is that they have a high percentage of reliability. They have a high percentage of reliability because they usually react to price after price has made a significant move. Moving average indicates the average price value over a period of time that has been set. So after a period of time in the Forex market is indicated by the candlesticks. So you set how many candles should be calculated by the moving average before it reacts to price. So you can set it to either 21 candlesticks, 8 candlesticks, 10 previous candlesticks, and so on. Like all indicators, traders use it to identify a trend. When price is above the moving average, it is considered to be in an uptrend. When price is below the moving average, it is considered to be in a downtrend. Most traders use two moving averages on their chart. When there is a crossover between the moving averages, it might be a sign of a reversal. Personally, I use the 8 EMA and the 21 SMA. EMA for exponential moving average and SMA for simple moving average. If the 8 goes above the 21, in my case, I will consider it as a bullish trend. And if the 8 goes below the 21 moving average, then price is in a bearish trend. Moving averages may also be used as dynamic support and resistance. For more details on support and resistance, watch our previous YouTube video explaining the topic in depth. Here's the link to the YouTube video. You can find it in the document that will be posted in our Telegram channel. So an example of dynamic support and resistance is here. Price came to this specific moving average and rejected from the moving average and began to start coming down. So this specific trader has a 20 pip target. You can also have a specific target where you take partial profits and let the other percentage continue to run. So here we had a moving average crossover and price came below the moving average, signaling that price is in a downtrend, making lower highs as it goes down. So we have a lower high here, a lower high here, a lower high here. You can see price finding dynamic resistance on our moving averages here. So after a moving average crossover here, you can use it as additional confluence to take all your profit from the market. And we had a trend reversal after the moving average crossover here. So after the moving average crossover here, price came back to retrace. We also have a break of structure here, signaling that this is a valid reversal. So we have a break of structure from the lower high here. Price also came down to retest the zone. I hope you can see these levels here marked out. There are grids here of the specific price levels. So price broke 1.1760 and came down to find support at 1.1750. So here we have additional confirmation from previous support here. There's support here. So price came here again, found some support. So again, price came down here to find some support. I explained these concepts in the support and resistance video, so make sure you go over and watch the video. So we also have additional confluence to enter the trade here because of the pin bar here and the bullish candle that followed the pin bar, signaling bullish strength coming into the market, because here we had a bearish candle here, but here the bears failed to keep up with their momentum and the bulls started coming in from here. We also have dynamic support here. We also have moving average crossover. So all these confluences are available for us to be confident in taking the trade. So price came in 20 pips. This specific trader has a target of 20 pips. So price came in 20 pips. This trader took out his profit. So you can also have a specific target point of where you can take your partial profits and let the other percentage continue to run. After you see a crossover, you can look for additional confirmation for why you should close your whole position. But always keep a specific target level of where you have set your take profit level. We come to Bollinger Bands. I'm sure most of you have used some of the indicators that I have mentioned in the video so far. If you have used any of them, make sure to leave a comment below on your experience when you used the indicators. Bollinger Bands are used to measure a market's volatility and identify overbought or oversold conditions, similar to the oscillators, but in this case, Bollinger Bands use moving averages. When there is low volatility in the market, the bands contract, and when there is high volatility, the bands expand. So the Bollinger Bands measure the volume of the traders available in the market. So Bollinger Bands measure the volume of traders in the market, and if there's a low volume of traders in the market, the bands contract. If there is a high volume in the market, the bands begin to expand. So you can use this as an indicator to predict whether there is a high number of traders in the market that are able to move the price. These indicators also act as dynamic support and resistance. So as you can see here, we had low volatility in the market. Price wasn't really making any significant moves. So the bands were contracted here. But after we had a huge number of traders coming into the market, we can see that the bands began to expand here. So you can find this chart on babypips.com. The link is in the document that you can find in our Telegram channel. Babypips.com is a trading website where you can learn how to trade, and they also give lessons on what cryptocurrency is. So I suggest if you're a beginner trader, you head over to babypips.com and begin to start learning how to trade. We have other types of lagging indicators, which is the moving average convergence divergence, which is the MACD. A good number of traders use this lagging indicator. I'll explain this lagging indicator in detail. You will find the document in our Telegram channel. I'll post the document in our Telegram channel where you find me explaining this moving average convergence divergence in detail. We also come to the parabolic SAR. You will also find another detailed explanation of the indicator in the document that will be posted in the Telegram channel during the course of next week. We come to the misconception about indicators. A large number of traders coming into the market think that indicators are 100% accurate and solely depend on them to make a trade. I'm here to burst your bubble. This assumption is not true. Neither leading indicators nor lagging indicators will be accurate all the time when it comes to predicting a trend reversal or continuation. How to use indicators. So from the misconception of how indicators are used, here is the actual way for how you can use indicators. Indicators should only be used for additional confirmation to make a decision in the market to either buy, sell, close a position, or wait for the right moment to pull the trigger. Caution: never depend only on an indicator to make a trade. Use it as additional confluence to make a decision. You do not have to put all these indicators on your chart. Choose one that best suits your trading and one that you are comfortable with. Make sure your chart is always clean. A lot of beginner traders have a lot of indicators on their charts in hope that these indicators will give them 100% accuracy on their trades and they will get rich in no time. But in trading reality, this is not true. Indicators can only be used as additional confluence to make a decision on whether to either make a trade, close a trade, or wait for the right moment to open a trade. We are coming to the end of the video. Before we go to the ending remarks, let's make a recap of what we have gone through in this video. What are indicators? A Forex indicator is a mathematical calculation that allows you to analyze or examine market data. Indicators seek to predict how the market will behave in the future and which patterns are likely to be repeated. Indicators can also be used as trend identification tools, and tools that may be used as additional confirmation for us to enter a trade. What are the different types of indicators? We have the leading indicator, which are also known as oscillators. These indicators give us a signal of a trend continuation or a reversal before it actually occurs. We also have the lagging indicator, which is an indicator which gives us a signal after the trend has already been established. The decision to choose on which indicator to use is made by you. Try to figure out which indicator works for your trading strategy and which indicator allows you to become profitable in the long run. Make sure you choose the indicator wisely. How do we use indicators? We use indicators as instruments or tools that may be used to help us make a decision in the market, to either buy, sell, close our position, or wait for the right time for us to take a trade. Thank you very much for watching the video this far. If you have gained any knowledge, don't forget to like, share, and subscribe to the channel for more videos like this. For more information about Forex, you can follow us on our Instagram page at Magna FX Institute. I'll leave the link to the page in the description below. You can also subscribe to our Telegram channel. You can also subscribe to our Telegram channel for exclusive content that I post on a weekly basis. You can find the link in the description below. Thank you very much and see you in the next video.